The latest developments surrounding the Vietnamese dong are drawing renewed attention from investors, currency watchers, and international markets as Vietnam continues to navigate a rapidly changing global economic environment. Over the past several weeks, discussions about the future value of the Vietnamese currency have intensified, with many investors searching for signs that a major revaluation could be on the horizon. However, the reality emerging from official economic data, central bank policy, and market trends presents a more complex picture than many speculative forecasts suggest. Good evening, and welcome to our special financial news report. Today, we take a detailed look at the Vietnamese dong, commonly known by its currency code VND, and examine the latest developments influencing its exchange rate, economic outlook, and the growing debate surrounding potential currency appreciation in the years ahead. Vietnam's economy entered 2026 with considerable momentum. Economic growth has remained among the strongest in Southeast Asia, supported by manufacturing expansion, rising exports, foreign direct investment, infrastructure spending, and continued integration into global supply chains. Economic officials have repeatedly emphasized their commitment to maintaining stability while pursuing long-term growth objectives. Recent banking sector data showed strong credit expansion during the first quarter of the year, helping support robust economic activity across multiple sectors. Despite this economic strength, the Vietnamese dong has not experienced the dramatic appreciation that some speculative commentators predicted. Instead, the currency has remained under pressure from broader international forces, particularly the strength of the US dollar, and changing global financial conditions. Analysts monitoring the foreign exchange market note that Vietnam's central bank continues to prioritize stability rather than allowing sudden movements in the value of the currency. One of the most important developments in recent weeks has been the continued elevation of the USD-VND exchange rate. Market reports indicate that Vietnam's central bank has adjusted reference rates while managing foreign exchange conditions carefully. Analysts from major Vietnamese financial institutions have suggested that while exchange rate pressures remain present, the expected movement in 2026 is likely to be moderate, rather than extreme. For investors hoping for an overnight revaluation of the Vietnamese dong, current evidence does not support expectations of a sudden jump in value. Instead, economists point toward a gradual and controlled approach. Vietnam's monetary authorities have historically preferred incremental adjustments designed to maintain export competitiveness, preserve financial stability, and attract long-term investment. A dramatic currency revaluation could create challenges for exporters, one of the country's most important economic engines. The debate over revaluation has nevertheless gained momentum because of Vietnam's increasingly significant role in the global economy. Over the last decade, multinational corporations have expanded manufacturing operations across the country. Electronics production, textiles, consumer goods manufacturing, and technology investment have transformed Vietnam into one of Asia's most dynamic economic success stories. Many supporters of a stronger dong argue that sustained economic growth should eventually lead to currency appreciation. Their argument is based on the idea that stronger productivity, rising incomes, increased foreign investment, and improved economic fundamentals should naturally support a stronger national currency over time. While this view has merit, currency valuation depends on numerous factors beyond economic growth alone. Interest rate differentials, inflation trends, trade balances, capital flows, geopolitical developments, and central bank policy all influence exchange rates. In Vietnam's case, policymakers must balance the interests of exporters, consumers, businesses, and investors simultaneously. Recent inflation figures have also become a significant factor in the conversation. Data released in early June showed that inflation accelerated during May, highlighting ongoing cost pressures within the economy. Rising fuel prices and broader global uncertainties contributed to higher inflation readings. While inflation remains manageable by international standards, it adds another layer of complexity to decisions regarding exchange rate management. Financial analysts point out that maintaining currency stability during periods of inflation requires careful coordination between monetary and fiscal policy. Officials have recently indicated that fiscal measures may play a greater role in supporting growth objectives, while monetary authorities continue to focus on maintaining overall economic stability. Another major factor influencing the Vietnamese dong is the flow of foreign investment. Vietnam continues to attract significant international capital, thanks to its strategic location, skilled workforce, and expanding industrial base. Several market reports indicate that foreign inflows could strengthen further during 2026 as structural reforms continue and investors seek opportunities in rapidly growing emerging markets. Foreign direct investment is particularly important because it provides long-term support for the country's external finances. When multinational companies build factories, expand operations, or establish regional supply chain hubs in Vietnam, they bring capital into the economy and help support demand for the local currency. At the same time, global market uncertainty remains a challenge. International investors continue to monitor developments in the United States, Europe, China, and other major economies. Changes in interest rates by the U.S. Federal Reserve can have substantial effects on emerging market currencies, including the Vietnamese dong. The strength of the US dollar has been one of the defining themes of recent foreign exchange markets. When the dollar strengthens globally, many emerging market currencies face depreciation pressure regardless of their domestic economic performance. This dynamic has been visible across numerous countries and remains an important consideration for Vietnam's monetary authorities. Currency traders are therefore watching two competing forces. On one side stands Vietnam's strong economic growth story, rising foreign investment, and expanding industrial base. On the other side stands the continued influence of global monetary conditions and dollar strength. The resulting balance has produced a relatively stable but carefully managed exchange rate environment. Supporters of a future revaluation often highlight historical examples of countries whose currencies strengthened after achieving sustained economic success. However, economists caution that every country's situation is unique. Vietnam's development model relies heavily on export competitiveness, making exchange rate management particularly important. A sharply stronger dong could make Vietnamese exports more expensive in international markets. Such a development might reduce competitiveness for manufacturers that have helped drive the country's remarkable growth over the past decade. Consequently, policymakers are likely to favor gradual adjustments rather than sudden changes. Recent forecasts from financial institutions generally suggest moderate exchange rate movements rather than dramatic appreciation. Some analysts expect the currency to remain relatively stable through the remainder of 2026, supported by foreign investment inflows and continued economic expansion, while still facing external pressures from global markets. For ordinary citizens, exchange rate stability offers important benefits. Stable currency conditions help businesses plan investments, manage costs, and conduct international transactions with greater confidence. Consumers also benefit from reduced volatility in imported goods and services. The banking sector has played a central role in supporting this stability. Officials have emphasized the importance of maintaining sufficient liquidity, supporting economic growth, and ensuring that financial institutions remain resilient in the face of global uncertainties. Credit growth during the first quarter reflected ongoing confidence within the domestic economy. Investors following the Vietnamese dong should also distinguish between market reality and online speculation. Social media platforms frequently feature claims of imminent revaluations, extraordinary exchange rates, or sudden wealth opportunities linked to currency holdings. Professional economists generally advise caution when evaluating such claims. Currency revaluations are significant policy events that typically occur within broader economic frameworks and are rarely implemented without clear communication from authorities. Historical examples demonstrate that major currency changes usually reflect specific economic objectives rather than speculative expectation. Current official policy signals continue to emphasize stability, sustainable growth, and gradual economic development. These priorities suggest that policymakers remain focused on maintaining confidence in the financial system while supporting Vietnam's long-term economic transformation. The manufacturing sector remains one of the strongest pillars supporting the Vietnamese economy. Global companies continue expanding production capacity within the country as supply chains diversify across Asia. This trend has strengthened Vietnam's position as a major exporter of electronics, machinery, garments, and consumer products. Export performance remains particularly important because it influences foreign exchange earnings. Strong exports generate foreign currency inflows that can help support exchange rate stability over time. As long as Vietnam maintains its competitive position in global trade, the underlying fundamentals supporting the economy remain favorable. Meanwhile, financial markets are increasingly focused on Vietnam's progress toward deeper integration with international capital markets. Continued reforms, modernization efforts, and improvements in market accessibility could attract additional foreign participation in coming years. Many analysts believe these structural improvements may ultimately contribute to a stronger currency over the long term. However, they emphasize that any appreciation is likely to occur gradually and in line with broader economic developments rather than through a sudden revaluation event. Another important consideration is regional competition. Vietnam operates within a highly competitive Asian economic environment. Neighboring economies also compete for investment, exports, and manufacturing opportunities. Exchange rate policy therefore remains a strategic tool for maintaining competitiveness and supporting national development objectives. The central bank's recent actions indicate a continued commitment to flexibility. By adjusting reference rates and utilizing various policy tools, authorities seek to balance domestic economic goals with external market realities. This flexible approach has helped Vietnam navigate periods of international uncertainty while maintaining relatively stable growth. Looking ahead, investors are expected to monitor several key indicators closely. These include inflation trends, export performance, foreign direct investment inflows, U.S. monetary policy decisions, global economic growth, and future announcements from Vietnamese policymakers. Each of these factors could influence expectations regarding the future direction of the Vietnamese dong. Stronger than expected investment flows, sustained export growth, and improving global conditions could support gradual currency strength. Conversely, renewed global volatility or a stronger U.S. dollar could create additional pressures. At present, the consensus among many professional analysts appears relatively clear. Vietnam's economic fundamentals remain strong. Growth prospects remain favorable, and long-term development trends continue to attract international attention. However, these positive factors do not necessarily imply an immediate or dramatic revaluation of the currency. Instead, they support a narrative of steady progress, managed stability, and gradual evolution. For holders of Vietnamese dong and those interested in the country's financial future, the most significant story may not be the prospect of an overnight exchange rate transformation. Rather, it may be Vietnam's continuing emergence as one of Asia's most important growth economies. and the steady strengthening of the economic foundations that underpin confidence in the national currency. As markets continue to evaluate incoming data and policymakers balance competing objectives, the Vietnamese dong remains at the center of an important economic story. A story defined not by sudden speculation, but by long-term growth, strategic policymaking, expanding international investment, and the ongoing transformation of one of the world's fastest-growing economies. That concludes our latest report on the Vietnamese dong, its exchange rate outlook, and the ongoing discussion surrounding future currency valuation. We will continue monitoring developments from Vietnam's financial markets, central bank announcements, and global economic trends as investors seek further clues about the future direction of the VND.